This is our Forex blog for December 2nd, 2011. And like most days, we really want to buy the strongest currencies versus the weakest and sell the weakest ones versus the strongest. You can see the Australian is extremely strong at 230 and pretty much stayed strong the whole day. The daily, weekly, monthly trend is up. So that's clearly one of the currencies you want to buy. Same thing with the CAD. Excuse me, and the New Zealand. The pound's weak on all time frames, so when you saw extreme weakness at and above the 80 level here, followed by less strength, that weakness is likely to continue if the longer term trend's down. Same thing with the euro. It was pretty much strong until really about 10 o'clock, but after 10 o'clock you could be looking to sell this versus whatever one most likely to be strong. The dollar's a little bit tougher because you have, for the most part, most of the momentum today was down. The daily trend's up, the weekly's down, the monthly's up. But from 9:30 onward, it's been very strong. So, you know, if you have your choice to buy the dollar, you want to do it versus the weakest one. At 9:30, the dollar became strong. Between the euro and the pound at 9:30, it appears that, you know, the euro had a little bit of weakness and the pound had a tiny amount of strength. So you might have sold the euro dollar from 9:30 onward. Here's the chart. And another reason to sell the euro dollar was because it's, you know, it had too many days up in a row. It came up and hit the Fibonacci area. And most of the time when you have a breakout over the previous day's high, that's bullish as long as it remains above there. So when this broke out and then came back down and wasn't able to get back above it, you pretty much knew that it was likely to reverse at least back down to the hourly moving average way back here at 8:30. You had an hour head start. If you miss that sell there, you have a beautiful little flag pattern, kind of wedge pattern right here, and this isn't the best trade in the world because your likely profit target's right here at 76. If it breaks that, there's a weekly pivot level here and another Fibonacci area at 58. Your likely max profit, you know, at the time was about 30 pips. Now, when a support area gets hit and the market stalls and isn't able to bounce, at that point, then you know that if it breaks down right here, the next profit target level is all the way down here at 18. That's almost 40 pips away. So the second trade right here is a much higher, or I would say a better trade, because anytime a support area is hit, especially when all the time frames are down, the real time's moderately weak. It's not quite at the 80 level, but it's quite weak. There's no strength whatsoever coming in on any of the other euro-dollar pairs, or else you'd see, you know, a spike here. So the euro is pretty much weak, or, you know, flat, going sideways against all the other currencies, or else you'd have, you know, a lot bigger green bars, you know, something like these. Anytime you sell a currency, you always want to know where the fib target is, because most of the time this is where you want to get out of the trade. Hit the first fib target, hit the second, you hit the previous day's low. I would get out of half the trade here because probably 80% of the time that's the maximum you're going to get. And then it continued down, and our intelligent trailing stop got you out down here at 88. But that was a huge 60 pip win on half and maybe 40 pip win on the other, so you netted about 50 pips on that. Now the Australian was very strong today, and earlier today the yen was quite weak. The daily trend is down, the weekly trend's also down. So the Australian yen was a great one to be buying earlier today. And you can see that this one kind of was going sideways. Yesterday it didn't move much, but the longer term trend is up. You have a beautiful multi-hour wedge pattern setting up right here. And this is kind of a low volatility pattern. When breakouts happen, usually the market will make a nice size move. And that's exactly what happened. You can see it broke out above the previous day's high, and unlike the euro dollar, it was able to stay above the previous day's high. And when that happens, you know, the trend typically continues up. Here we have two major counter trend signals. The yellow signals for our counter trend are the highest probability, and the yellow triangles are the highest of all probability. This is basically telling you that the Australian yen's probably been going up 3 to 6 days straight with incredible intensity and has moved statistically way too much. And this is a very high probability reversal area. So once you start seeing these counter trend signals like this, it becomes very safe to draw your fibs on there. and start selling at the next fib targets up. In this case, it was 6 pips away from that. You can see it was quite strong there. If you don't want to sell a currency that's this strong, wait for a little bit of a pullback where it breaks the previous swing low, and then on the way back up, if you see it has less strength than the previous weakness, this is a very high probability trade. And because these are usually the end of the move, from this point on, you really want to sell every up move. So, you got out of this trade right here from 10, came down to the hourly moving average. This is a very good profit target, and so you made about 35 pips on that. You wait for a pullback, you got into this trade here, you probably had a loss. You get short again right here at 94, and this one, if you got out at the trailing stop, you're out at 64, 30 pip win. The key to trading is small losses, big wins. The CAD was also strong today, and the yen was weak, so you could have also done a CAD yen sell. Notice the trend reversal triangles. This, they almost always lead to a reversal, but not necessarily always immediately. And if the market makes another wave up, draw your fibs on there. This is a very high probability area for the market to reverse, and I draw my Fibonacci areas each night off of longer term areas, and you can see one of them was right here, one of them was right here, the gray, dark gray Fibonacci profit target levels. It went almost to the pip where my Fibonacci profit target level was, and fell almost 80 pips. So that, combined with the counter trend signals here, you really want to, you can trade these with the trend, but just be aware that this, today's trend is likely to end. You draw your fibs off this last one. And one of the reasons why we use trend lines underneath the bar's lows in order to get into a trade is to simply avoid some unnecessary losses. You can see this was very strong at the time, and you might have even wanted to wait for some signs of weakness. Here it falls, goes back up. Notice the strength on the way up is less than the weakness on the way down, and so this is a much safer place to go short. And you can see it fell about 40 pips over the next few hours with a lot less risk. It was very likely to reverse today, but you never know. When you see real-time strength like this, if the CAD is super strong and the yen is super weak, sometimes they just keep going and going. It's a rare event, but it is an event that you have to be aware of so that you don't wipe out your account with one trade. What if you took counter trend trades like this and 80% of them worked, and you gave back all your profit and your capital on one trade that, for news-related reasons just kept going and going? So, be cautious. Another much easier way of doing counter trend on these type of trades is using something called a range bar. If you bring up a chart with 6 pips per bar, we'll just put 2 days of data on here so it loads faster. We're looking to sell this up here from 6 to 7, and on a range chart you can get into these at much higher probability areas. In other words, as it's going up, the first time I see a red bar, I will sell it right here, and I will put my stop a pip or two above the high. So it's a very high winning percentage most of the time. The majority of the trades work. In this case, the first one didn't. You would have been short here and lost a little bit less than 10 pips. And then, but guess what? The second trade, you're short here, you stop above the high, and it pulled back from 28. And even if you got out of it somewhere up in here, you made 25 pips. And most of the time when markets are up too much, they'll make a two-wave move down. So you draw your fibs on here, and this is where you would exit the trade at 78. Short at 28, out at 78. So now you got 50 pips. So if you lost 10 pips on one and made 50 pips on the second one, you've netted 40 pips. You're 50-50, but you're up 40 pips. And really, that's the key to trading. And once the market goes, makes a double wave pullback, this is actually our Elliott two-wave system for a counter trend trade. For a trend trade. If the market can't break this high up here and go sideways, it makes sense to sell this when it goes right here. And again, most of the time, it's going to make a wave now of this, and that's where it stalled. Notice the second trade up here at 16, out at 54. You made 65 pips the second time. So between, all the trades, you lost 10 pips. You made 50, so you're only up 40 now. And even if you got out of this third one here around 80, you made 40 pips on that. So you've made 80 pips on 3 trades. 2 wins, 1 loss. Or if you got out of that trade there and look to sell it again, you're realizing that this is likely to be the major support area, and you got short again, you made another 20 or so pips. And that's how you can use our range charts to really surf the market.